Hey, this is Stefan, Director here at Prudent Wealth Strategies. And when it comes to these advanced tax structures, there are two fundamental actions that you have to avoid in order to qualify for legal tax exemptions. And in this quick tutorial, I'm going to walk you through both of those actions. The first is constructive receipt. You have to avoid the action of constructive receipt. Now, if you're not already familiar with this term, it's just fancy IRS language for who's getting paid. That's all it is. And once you receive income, once you get paid, that's constructive receipt. Even if you receive a check that you haven't cashed yet, if it's written out to you, it's still considered constructive receipt for that year. Now, all this means is that you've triggered a taxable event, and now Uncle Sam can get his grubby little hands on your money, which is not good. Now, let's say you're doing a 1031 exchange, or you're investing in an opportunity zone, or 401k or IRA. In those cases, you're obviously deferring the income, right? You haven't received the income yet because it's invested somewhere else. You're just delaying constructive receipt. You're not avoiding it. Eventually, when you cash out that investment, you will have constructive receipt and you're gonna pay taxes on that money. Now, on the flip side, when you redirect your earnings to a tax structure, you're avoiding constructive receipt. There's no taxable event because the entity, other than yourself, the tax structure, is receiving the income. And that entity is tax exempt. It doesn't pay taxes. Now, in order to keep that tax exempt status, one of the things you have to do is avoid the action of self-dealing. Now, what is self-dealing? Well, every tax structure has a fiduciary, whether it's a corporate officer, trustee, or attorney, that acts in the best interest of the beneficiaries. However, the fiduciary and the beneficiaries cannot be the same people, or sometimes they can't even be related. There has to be a truly arm's length relationship. So you as an individual cannot have any ownership stake in that structure. Any transactions that are considered self-dealing can cause you to lose out on exemptions, pay taxes, fines, possible jail time, and a whole bunch of other things you probably don't want to find out. So, long story short, when you're setting up these specialized tax structures, you want to do things the right way and the legal way. And that's what our team can help you do. So that's it. If you haven't already scheduled a discovery call, do so as soon as possible to see how our team can help you avoid the tax, keep your cash, and be more tax efficient. So that's it. See you in the next training. And remember, Uncle Sam is not your own.